Hello everyone and welcome to our newest video here at Bullion79. In today's video, we will talk about money creation and how money is created and enters the money supply. And I will also be debunking fractional reserve banking in the process and get into real life examples later in the video. So stay tuned. So there's a myth going around that banks cause inflation by creating money out of thin air. That is because of fractional reserve banking. And it's really frustrating finding a series of sources because pretty much every single YouTube video or article focuses on the later part of how money enters the economy, while completely ignoring the actual source of the expansion of the money supply in the first place. All right, so let me explain the argument. But before I start, why don't you subscribe and share and click the bell button to not miss any of our newest videos. Let's get started. So fractional reserve banking is a regulatory measure that mandates banks to keep a certain percentage of total deposits as reserves and invest the remaining to maintain a banking system's functioning. In other words, let's see you deposit $100 and the bank loans out $1,000 to you while keeping a fraction of that deposit money as their reserve. They can do that because they're allowed to have a certain amount of liabilities. This process can be repeated indefinitely and money is magically created and enters the economy through credit. This is also why bank runs are so bad, because if everyone decides to pull out their money all at once, banks did not keep any of the deposit money as their capital, so the money doesn't actually exist. It was simply created as a new liability entry on a bank's balance sheet. Making sense, right? That's basically the argument. So there's just one factor we're missing here, and that is that most assets the bank owns are in the form of loans that they themselves back up by credit. It's true that the money you deposit doesn't increase the bank's capital. They simply don't need your money to create credit because private banks use repo markets to swap cash around to increase or decrease their reserves/capital to back up the allowed amount of liabilities. So most of the bank's assets don't need to exist in the form of capital, but do exist in the form of loans that they back up with their own credit. They can do so through repurchase agreements or repos, which is a form of short-term borrowing from central banks in government securities or bonds. In the case of a repo, a central bank sells government securities to commercial banks, usually on an overnight basis, and buys them back the following day at a slightly higher price. That small difference in price is the implicit overnight interest rate. Well, at least in theory. But realistically, there's nothing to stop the overnight interest rates to be near zero. So repos are used to raise short-term capital. They also are a tool of central banks for the open market operations. Repos are how banks maintain their reserves, and if a commercial bank needs cash and no other bank is there to lend it out to them, the commercial bank can just borrow money from the central bank. So the money that commercial banks supposedly create through credit is in fact backed up by credit to the central bank, which creates money out of thin air. This whole money creation chain starts with the Treasury selling government securities to the central bank. The central bank buys those securities or bonds with money that they create at super low interest rates. This way, the government now has money that they can spend on whatever welfare program or other forms of free money they promised to give to their citizen to get re-elected. That newly created money can enter the economy directly and be injected through stimulus checks or certain funded programs or through the repo markets. That is what increases the money supply and causes inflation. Not the commercial bank giving you a loan. That happens at the end of the chain of money creation. So if repos are used to flood the economy with new money and give commercial banks fresh cash, then reserve repos are supposed to do the opposite, right? If inflation is running too hot and the central bank needs to cool down inflation, they can slow down the demand by doing reverse repos. I want to show you a certain chart. Here's a chart for everyone arguing that banks create most of the money and only a tiny amount is created by the Fed. Look at this. This is all the money that was printed right after the 2020 COVID crash. The inflation we're facing today, more than 3 years later, has nothing to do with it. Well, banks could have created all this money, all this time, but inflation only really happened right after 2020. Strange. Here's another chart. Here are the numbers of reverse repos just about a year after the massive amount of money that entered the money supply through the Fed, the American Central Bank, by creating all this money out of thin air. Also, here's a small detail. Money saved in the savings account has been removed from the M2 money supply. Yeah, you heard it right. It has been discontinued right after the release of these numbers to hide where the inflation is actually coming from. So do commercial banks create money? Not really. If you don't believe me, well, here's an article right from the Bundesbank themselves. So it says here, quote, despite its ability to create money, a bank still has to fund the loans it has created since it needs central bank reserves for their cashless settlement of payments when sight deposits created by lending are transferred to other banks. These balances, which only the central bank can create, again, can commercial banks create money? Sort of. Can they increase the money supply, meaning actually create money? No. Only the central bank can do that. So right now you might be asking yourself, what's the big deal? Why is it so important? Why are you making a whole video about this? Well, I tell you why. Because it's there to fool you. It's there to fool you and blame everyone else but the government for the problems that they created. And if you say, oh well, I thought the central bank is a private entity. Think again. Which private entity gives out loans and prints money on demand for 0% interest? Which private entity does that? That doesn't make any sense. In short, the Federal Reserve creating money is basically the government printing money with extra steps to make things more complicated and confuse you into blaming private banks and corporations or anyone else but the government for causing all this inflation. That's also the reason no one explains the source of this expansion of the money supply to you. And almost all sources, including government websites, talk about the myth of money creation through fractional reserve banking alone. So it's central banks or the Federal Reserve creating money causing inflation, not commercial banks. But I have one last point before we end this video. Let's use a real-time example that is going on right now. I'm talking about the bank bailouts that happened in the spring last year, starting with Silicon Valley Bank that triggered a bank run and spread out to other major banks too. The ongoing crisis in the US banking system, which seems to have been resolved with a government bailout, is far from over. Initially, the US government intervened with a $60 billion bailout, a loan due to mature in March of 2024, that's next month. This temporary solution has not fully addressed the underlying issue. The data suggests that without this emergency intervention, the situation could have been far worse, potentially surpassing the severity of the great financial crisis. The Federal Reserve's response include the creation of the Bank Term Funding Program, initially capped at $60 billion, which has now alarmingly escalated to $123 billion. Contrary to expectations of a decrease, the loan amount has doubled. The necessity to repay these loans with accruing interest is likely the reason behind Jerome Powell's recent hint at potential interest rate cuts. The market is currently bracing for a 78% probability of rate cuts by spring. The root cause of the banking crisis we saw, and which is still ongoing, stems from high interest rates, leading to significant losses on bank bonds. In a bid to stabilize the situation, the Fed offered emergency loans to banks, mandating repayment within 12 months. The deadline coincides with the predicted timing of the first rate cuts in March 2024. If the Fed fails to cut interest rates, then repaying this debt could become infeasible. The scenario possesses a substantial risk. If the Fed commences rate cuts prematurely before inflation is fully under control, we risk reigniting inflationary pressure. The situation could mirror the events of the 1970s stagflation, where the final inflation peak was much higher than the initial one. Historical charts comparing rate cuts from 2020 to the present with those of the 1970s indicate striking similarities of potential repercussions of such actions. In these uncertain times, it's crucial to stay informed and prepared. I encourage you to follow my updates here on Bullion 79 and engage in the discussion in the comments below and remain well equipped as we navigate through these crazy times together.